Hi, everyone. Today is June 22nd, 2022. I am Ashley Wilkins, Senior Wealth Manager with the Rice Partnership, and I have Orest Saikevych here, our Chief Investment Officer. Hi, Orest.
Yeah, hi Ashley. Hello again, everyone.
So as we know, this has been a pretty tumultuous year with things like rising interest rates, the war in Ukraine, inflation, and supply chain issues. All those things combined have pushed us into a bear market, the S&P down over 20% year to date. So, Oris, my first question for you is, what is exactly a bear market, and what are we doing in client portfolios as a result of where we are today?
Okay. A bear market is generally an index 20% or more down from its high. Uh, the S&P 500 is the most commonly used index. It is in a bear market. Others, such as the NASDAQ and the Dow Transports and the Russell 2000, are also in bear market territory. As far as what we've been doing uh, in portfolios, I think few prognosticators predicted a bear market 6 months ago at the beginning of the year. We basically looked at economic fundamentals as they came out, and as those fundamentals dimmed, we steadily raised cash in portfolios. In early January, when the Fed said that they would be more aggressive about raising interest rates, we gave haircuts to a lot of the mega caps and expensive stocks. Then in late February, with the Ukraine war breaking out, we sold stocks that were vulnerable to inflation and bought energy and defense stocks, which basically should do well in the next few years because of the geopolitical risk. Then, as uh, the economics, the economic growth uh, uh, softened a bit recently, we trimmed stocks that were vulnerable to a big slowdown in the economy, and we've added consumer staples and defensive type names that should do well in a slow growth or in a recessionary environment.
So, what is the difference between a bear market and a recession? And are we headed for a recession?
Recessions usually feature bear markets that are down one third or more, roughly 33, 34% or more. Right now, we would give the probability of a recession within the next 18 months at about 50-50. That's gone up quite a ways. There, of course, are the negatives out there with elevated inflation that hasn't peaked yet, with the Fed really focused on bringing that inflation rate down by raising interest rates significantly, the geopolitical risks, etc. That's balanced out right now by the yield curve. The yield curve 3 month to 10-year Treasury is still positive, still steeply positively sloped, which is good for the economy. Also, consumer savings, still quite a bit of uh, savings from the pandemic stimulus. Also, consumers and corporations have good balance sheets, so that should help the economy. We've just about gotten the kitchen sink thrown at us in the last 6 months as far as bad news is concerned, and the S&P is down about 1,000 points from 4,800. Even in a bearish scenario, we're, uh, our guess is that we're probably about 2/3 of the way through. So even in a bad worst case scenario, and any kind of positive developments we may get, like for instance, a ceasefire in Ukraine or something like that, could cause a sharp rally, which is why we currently have the asset allocation where we're at, where we pulled back in equities And we've added the fixed income, although we've added in shorter term fixed income without duration risk. So hopefully that helps a little bit about where we are right now. Things have moved very quickly and are continuing to move, and we will be making adjustments as the economic reports come out.
Thank you, Orest. We appreciate your insight as always, and we look forward to another update next month.
Thank you, Ashley. Take care, everyone.